In 19 months, Adam Neumann turned a $47 billion company into a cautionary tale. WeWork didn't fail because of the business. It failed because of the man running it. And if you'd asked 5 simple questions before buying in, you would have seen it coming. Warren Buffett once said he looks for 3 things in a CEO: intelligence, energy, and integrity. And if they don't have the third one, the first 2 will kill you. But how do you actually evaluate that from the outside? You can't sit across from Tim Cook over dinner. You can't audit Jamie Dimon's character. What you can do is ask 5 specific questions. The same 5 questions that separate great operators from value destroyers. And the 5th one is the one almost everyone gets wrong. Every dollar a company earns has to go somewhere. And how a CEO chooses tells you almost everything. There are really only 5 options. Reinvest in the business. Buy other companies. Pay dividends. Buy back shares. Or pay down debt. Great CEOs are obsessive about this choice. Henry Singleton ran Teledyne in the 1960s and 70s. When his stock was cheap, he bought back shares, reducing the share count by about 90% over 15 years. When competitors were overpaying for acquisitions, he sat on cash. The result? Compound returns of roughly 20% annually for 2 decades. Now compare that to a CEO who issues stock at low prices, makes overpriced acquisitions to chase growth, and pays dividends his company can't afford. You see this pattern all the time. And it always ends badly. Read the annual letter. Look at the last 10 years. Where did the money actually go? Question 2. How much of their own money is on the line? When Jeff Bezos took Amazon public in 1997, he kept the vast majority of his shares. Through every crash. Through the dot-com bust when Amazon dropped over 90%. He didn't sell. Compare that to the CEO who pays himself in cash bonuses, dumps stock the moment options vest, and hedges his exposure with derivatives. That's not a partner. That's a tenant. Look up insider ownership on any financial site. If the founder or CEO owns less than 1% of a company they've run for 10 years, ask why. And here's a subtle one. Watch what they do, not what they say. A CEO who buys shares with his own money during a market panic? That's a signal. A CEO who only sells? That's also a signal. Every business has setbacks. The question is, does the CEO own them or hide them? Read Warren Buffett's annual letters. He spends pages explaining his mistakes. He called his Dexter shoe acquisition, quote, the worst deal I've ever made. He admits when he's wrong. By name. With numbers. Now read the average CEO letter. It's marketing. Buzzwords. Vague references to headwinds and challenging environments. No specifics. No accountability. Here's a simple test. Pull up the company's last 5 annual reports. Search for the word mistake. Search for failed. Search for we were wrong. If those words don't appear, you're not getting the truth. You're getting a press release. Show me a CEO's pay package, and I'll show you how they'll behave. If they're paid based on this year's earnings per share, they'll buy back shares to hit the number, even if the stock is overvalued. If they're paid on revenue growth, they'll make bad acquisitions to grow the top line, even if profits suffer. If they're paid on the stock price over 10 years, with personal capital at risk, now you have alignment. Look at the proxy statement. Every public company files one. It tells you exactly how the CEO is paid, what the targets are, and how much they own. And one more thing. Compare the CEO's pay to the median worker's pay. Not because high pay is automatically wrong, but because a ratio of 1,000 to 1 tells you something about the culture at the top. Here's the question almost everyone skips. What did the CEO say 5 years ago, and did it actually happen? When Satya Nadella took over Microsoft in February 2014, the stock was around $36 a share. Microsoft was seen as a dinosaur. Mobile dead. Cloud late. A washed-up empire. Nadella laid out a clear vision. Cloud first. Mobile first. A complete cultural reset. A decade later, Microsoft is worth roughly 10 times what it was. Not because of luck. Because the man delivered exactly what he promised. Now think about the opposite. Elizabeth Holmes promised Theranos would revolutionize blood testing. The company was valued at $9 billion. The technology didn't work. None of it. You can't always know who's lying. But you can compare past promises to present results. Pull up an interview from 5 years ago. Pull up a letter from 10 years ago. Did they deliver? Or did the story keep changing? A great management team has receipts. Here's what most investors miss. When you buy a share of a company, you're handing your capital to the people running it. They decide what to do with your money. They decide whether to grow, to return cash, to take risks, to be honest. Capital allocation. Skin in the game. Honesty in failure. Aligned compensation. A track record of delivering what they promised. 5 questions. Ask them every single time, and you'll avoid most of the disasters that destroy ordinary investors. So tell me in the comments. Which CEO do you trust the most with your money, and why? I read every reply. If this changed how you think about evaluating companies, hit subscribe. We're here every single day, breaking down the principles that build fortunes. Tomorrow, we're tackling something a little uncomfortable. The one number on a balance sheet that even pros get wrong, and how it can save you from your next bad investment. This is educational content, not financial advice. Always do your own research before investing.